Hey everyone, welcome back to Corporate Decoder. Today, Akso Health Group just filed its annual report with the SEC, and I'm seeing one major red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a massive net loss, and a worrying trend in its cash position has me looking closer at its survival. Let us start with the auditor's report. First up is CHI-LT, who say the financials are fairly presented, but then they hit us with a big warning about a material uncertainty related to going concern. This means the company might not be able to stay in business for the next year. They've had a huge net loss of about $18.7 million for the last year and $135.5 million for the year before that. Their accumulated deficit, which is basically total losses over time, is also massive, reaching over $217 million. On top of that, they used up a lot of cash, $12.8 million, just in the last year's operations. It sounds like the company is bleeding cash. Looking at the numbers, the net loss line tells a stark story. For the year ending the 31st of March 2026, the company reported a net loss of over $18.7 million. This is a huge improvement from the previous year, where they had a net loss of nearly $135.5 million. Still, even with that improvement, the company is losing a lot of money. Now, let us not forget about cash. As of the 31st of March 2026, their cash and cash equivalents were only about $0.2 million. That is a massive drop from $176.2 million just a year prior. This significant decrease in cash is largely due to their investing activities, where they spent a lot of money, over $163 million, on developing new business modules. But here is the kicker: in June of 2026, they got a refund of $1975.7 million from vendors. This refund dramatically improved their cash situation right after the year, and bringing their total cash up significantly. It is good they got that money back, but it highlights how much they were relying on those vendor payments and also shows how much they spent on that internet hospital project, which appears to have failed. This is where things get really interesting. The company recorded a massive impairment charge for goodwill and intangible assets. For the year ending the 31st of March 2026, this charge was over $16.7 million. But in the previous year, it was a staggering $162.4 million. These charges largely relate to the acquisition of Tianjin Wangi Cloud Technology Company. It seems the company overpaid significantly for this acquisition, and the value of what they bought has plummeted. They had to write down the value of the internet hospital license they acquired because the project became commercially unviable after they terminated development agreements with suppliers and global supply chain issues increased costs. They also had to write down goodwill, meaning the value they thought they were getting from the purchase just was not there. Let us look at their revenue for the year ending the 31st of March 2026. Net revenues were about $13.8 million. This is a slight decrease from the previous year. While their medical device sales have evaporated, their marketing promotion services, which they started in April 2024, are making up most of their income. But even that revenue saw a small dip. Their marketing promotion service business is barely breaking even, with a gross profit of negative 0.1% for the last year. And remember, this is before even accounting for all their other operating costs. This demonstrates the razor-thin margins and intense competition in this sector. Overall operating expenses saw a huge drop, mainly because the massive impairment charges from the prior year are not repeating. For 2026, operating expenses were about $20.7 million, a big decrease from $166 million in 2025. This looks good on paper, but it is mostly due to writing off bad investments, not from cutting costs on active operations. Now, let us talk about risks. The company operates in China, and this section details many of the challenges. They are facing regulatory uncertainty, data security concerns, and foreign exchange risks. The report also mentions the Holding Foreign Companies Accountable Act, or HFCA Act, which could lead to their stock being delisted from US exchanges if their auditor cannot be inspected. This is a serious risk for any US-listed Chinese company. The auditor's report for the 2025 financials issued by One Stop Assurance Pack also flagged going concern uncertainty and noted material weaknesses in internal controls. While the new auditor Chirisi is reporting an unqualified opinion for 2026 financials on internal controls. The lingering going concern warning from both auditors is still a significant signal. The fact that they had to get a huge cash refund in June 2026, right after their fiscal year ended, is a strong indicator of financial stress and reliance on external factors for liquidity, my take. Akso Health Group is in a very precarious financial position. They are trying to pivot into healthcare services, but the massive goodwill and intangible asset impairments suggest they have made costly mistakes in their acquisitions. Their revenue streams are fragile, and the significant drop in cash despite receiving a large refund is concerning. The going concern warning from their auditors is a major red flag, and the HFCA Act risk adds another layer of uncertainty. The big question is whether their new healthcare ventures, especially the expansion into China's online hospital and pharmacy segments, can generate enough profit to steer them away from deeper financial trouble. The path forward looks incredibly challenging. That is my take. Stay decoded. If you found this analysis helpful, please consider liking, subscribing, and joining our Discord community, linked in the description.